What does aggregated risk mean in the world of property and casualty insurance, and why is it such a big deal for insurers? In today's video, we're breaking down how insurers manage aggregated risk across their portfolios, what challenges and trade-offs they face, and how technology and specialized talent are shaping the future of risk management. If you're curious about how insurance companies manage risk at scale, or looking to explore a career in this space, this video is for you. Let's start with the basics. In P&C insurance, aggregated risk refers to the total exposure an insurance company has across similar or connected risks. Instead of looking at individual policies one by one, insurers zoom out to evaluate how much cumulative risk they've taken on in certain areas, whether that's geographic concentration, types of coverage, industries, or exposure to specific perils like hurricanes, earthquakes, or liability trends. For example, let's say an insurer writes hundreds of homeowners policies across Florida. If a hurricane hits, that's not one claim. It could be thousands. That's the kind of aggregation that can threaten an insurer's financial stability. That's why insurers constantly monitor their aggregate risk exposure. Too much concentration in one area, even if each individual risk is profitable on its own, could lead to catastrophic losses if something goes wrong. Risk management teams work to spread that risk out, by geography, line of business, industry, or customer type. Now here's where it gets interesting. There's always a trade-off between growth and concentration. Insurers want to grow. But if all that growth comes from one region or one product line, they could be taking on more risk than they realize. For instance, let's say a carrier sees strong growth in commercial auto in Texas. That sounds great, until you realize that court verdicts in that region are rising rapidly, and now the portfolio is overexposed to severe liability claims. That's why insurers put aggregate risk thresholds in place. These limits help underwriters know when to slow down or redirect growth in specific segments to maintain a balanced portfolio. But these decisions aren't always easy, especially when certain areas of the market are more profitable or growing faster than others. So what happens when insurers don't manage aggregation carefully? The consequences can be severe. Natural catastrophes, systemic liability risks, or even inflation-driven loss-cost trends can lead to major losses that ripple across the portfolio. A good example is the recent rise in secondary perils, wildfires, convective storms, and flash floods, which have caught some insurers off guard because of underestimated exposure in what were once considered moderate risk zones. Fortunately, technology is playing a growing role in managing aggregate risk. Advanced modeling tools now help insurers map exposures in real time, visualize how much risk is concentrated in specific zip codes, or model what a multi-event catastrophe season might look like. Geographic information systems, predictive analytics, and portfolio optimization software are giving risk managers deeper insight into their portfolios than ever before. Additionally, AI is being used to simulate stress testing scenarios across portfolios, helping insurers plan for worst-case outcomes and calibrate their growth strategies accordingly. This means insurers can proactively make adjustments, whether it's tweaking underwriting appetite, buying more reinsurance, or shifting distribution efforts. Now let's talk about the people behind the scenes. Managing aggregate risk isn't just about software. It's a collaborative effort involving multiple roles: actuaries, catastrophe modelers, underwriters, risk managers, and portfolio strategy professionals all work together to evaluate exposure trends and ensure the company is staying within risk tolerances. On the investment side, capital and reinsurance teams help design financial buffers in case those risks materialize. If you're thinking about a career in insurance and like working with data, strategy, or solving complex problems, this could be a great path. Roles in exposure management, portfolio strategy, and risk analytics are growing fast, especially as insurers adopt more advanced tools and need new talent to interpret and act on that data. Looking ahead, the future of aggregate risk management is only going to become more important. As climate change intensifies, catastrophic risks and litigation trends become harder to predict, insurers will need smarter ways to track, model, and control exposure. This means more investment in tech and more demand for professionals who can translate that data into strategy. So whether you're a student, early career professional, or someone curious about how insurers manage massive portfolios, understanding aggregate risk is a foundational concept that will only grow in relevance. If you found this breakdown helpful, don't forget to like the video, subscribe to Insur Knowledge, and follow us for more insurance insights, career tips, and trends shaping the future of property and casualty insurance. Thanks for watching.